Right. Hi, everyone. Welcome to today's webinar brought to you by Vantage Markets, where we'll be taking another look at the central bank spotlight. And this time it's going to be the European Central Bank, otherwise known as the ECB. All right, before we proceed, just want to let you all know we are streaming directly into the Vantage app as well as over Zoom. So do not hesitate to drop your relevant questions. Do not hesitate to drop your questions in the relevant chat boxes as we progress through today's webinar. Right. Okay. Right, before we get going, here's the disclaimer. Right, take note that the information, context, and opinions which are expressed in this presentation and on the following slides are solely those of the presenter and not necessarily those of Vantage and are solely used for educational purposes, as they do not constitute investment advice and or consultation on how a client should trade. Also, take note of the risk warning that comes with trading margin forex and CFDs, as they carry significant risks and is not suitable for all investors. Right. My name is Ketan Ramachandra. So this webinar series is brought to you in a special partnership between Vantage Markets and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. Right. So the most recent ECB monetary policies meeting took place on 17th of October, Thursday, right, about 3 weeks ago. Right. So we'll take a look at what were the key takeaways in the statement, as well as during ECB President Christine Lagarde's press conference. We'll look at what was the immediate reaction from the euro and how it has progressed since then. And also, we'll take a look at some of the key macroeconomic data and how that could impact the ECB over the next few months. Right. So as we all know, on 17th of October, the ECB reduced all three key interest rates by 25 basis points, marking the second successive rate cut. Right. In total, they've already done three rate cuts in total this year, but this was the second successive rate cut of 2024. Now, this follows a jumbo cut of 60 basis points that took place in September. Now, accordingly, the main refinancing rate, marginal lending facility, and the deposit facility now all stand at 3.4%, 3.65%, and 3.25% respectively. Now, the reason for moving ahead with the second successive rate cut is primarily due to the disinflationary process being well on track, and the inflation outlook is also has been affected by recent downside surprises in indicators of economic activity. Right, if economic activity is slowing down, right, that means demand is also pulling back. So that in turn is going to have further moderation on prices. Right. Now, in September, inflation in the Eurozone, this is headline CPI, fell below the ECB's target of 2% for the first time in more than 3 years, dropping down to 1.7% on an annualized basis, right? So we can see headline inflation is also falling, uh, has fallen below the ECB's target of 2%. Now, whether it remains there is something that needs to be seen over the next few months, right? It's one thing for inflation to drop down to drop underneath the target just once, but what we're looking for is a more sustained readings under the 2% target over the next few months. Now that's going to be much more convincing for the ECB to move ahead with, or rather, that would give the ECB further conviction to move forward with more successive rate cuts. Now, however, we see inflation is expected to rise in the coming months before declining to the target of 2% over the course of next year, right? So take note, although headline CPI has dropped down to 1.7% year over year in September, right? The forecast is for inflation to pick up slightly as we come to the end of 2024. However, we can then expect inflation to continue to moderate lower throughout 2025. Now, domestic inflation remains high as wages are still rising at an elevated pace, while labor cost pressures are set to continue easing gradually, right? So cost pressures are continue to ease gradually, but we can see with wages remaining at rising at an elevated pace, it points to a higher uh, spending power of the EU consumer, right? And that is why domestic inflation remains relatively high. Now, the Eurosystem no longer reinvests all the principal payments from maturing securities purchased under the Pandemic Emergency Purchase Program, otherwise known as the PEPP, and have reduced its portfolio by 7.5 billion euros per month on average. Right, so this is basically quantitative tightening as well, right? So the Government Council intends to discontinue all reinvestments under the PEPP until the end of 2024. Right. So the next meeting now will take place on 12th of December, right? So we can see here, right, the main takeaway from the statement is that we can continue to see inflation, or we have seen headline CPI fall under the ECB's target of 2%, right? And we can also see downside surprises in economic activity, right, which all point to lower demand, and then that could have a knock-on effect on inflation continuing to moderate lower, right? But in the near term, right, in the near term, inflation is expected to pick up slightly as we close out 2024, but and during the course of 2025, we can expect see inflation to probably remain sustainably under the 2% target. Now, let's move on over to some of the key quotes by President Lagarde during her press conference. Right, these are some key statements that I pulled out from her press conference, and it doesn't point to a very bright outlook with regards to economic activity in the euro area. Right. So the first statement is the incoming information suggests that economic activity has been somewhat weaker than expected, right? With industrial production being particularly volatile over the summer months, surveys indicate that manufacturing has continued to contract, right? We have seen over the last 18 months or so, manufacturing activity throughout the euro area has remained in contraction, highlighting this ongoing downturn for this sector, right? Remember, with Germany being the economic powerhouse of Europe, even their manufacturing sector has taken a beating and is having widespread repercussions throughout Europe for this for the manufacturing sector. Now, looking at services, surveys showed a slight uptick in August. Right, this is likely supported by strong summer tourism season, but the latest data point the latest data points to more sluggish growth, right? Businesses are expanding their investment slowly, while housing investment continues to fall. Exports have weakened, especially for goods. So that means demand from outside of the EU, right? Of course, has pulled back quite strongly. Now, although incomes rose in the second quarter of this year, households also consumed less, which is contrary to expectations, right? So we can see there's also some slight pessimism among EU households, right? Because if you expect incomes to rise, you would also naturally expect consumption to increase gradually or increase slightly as well. However, we have seen consumption actually reduced, and this highlights the pessimism among EU households. Right now, taking a look at the labor market, President Lagarde mentioned that for now, the labor market remains resilient as the unemployment rate stayed at its historical low of 6.4% in August. However, recent surveys point to slowing employment growth and further moderation in the demand of labor. So moving forward, right, we can probably expect uh, the labor market in the EU or the euro area, sorry, to weaken further. Now, she also highlighted the risk to economic growth, right? Uh, Explaining that downside risks are being highlighted, right? As lower confidence could prevent consumption and investment from recovering as fast as expected, right? So you can see optimism and business sentiment and consumer sentiment are low at low levels, and this could pose further downside risks to overall economic growth. Now, lower demand for euro area exports, right, for instance, could lead to a weaker world economy or an escalation in trade tensions between major economies, right? If these two things were to play out, it would also weigh on the euro area growth even further, right? So take note, lower demand externally is also having a huge impact on the recovery or the economic growth of the euro area. Right. Growth could also be lower if the lagged effects of monetary policy tightening turn out to be stronger than originally expected, right? So take note, they took a while before most central banks have waited uh, before moving ahead with their first respective rate cuts. And we can only know whether this lagged effects will actually come into place or into play over the next few months. Right, so these were some of the key quotes from ECB President Christine Lagarde during her press conference. Now looking here, we have the chart that shows the level of the main refinancing rate over the last 10 years. Right, we can see a sharp acceleration or the sharp increase uh, in the second half of 2022, right, as the ECB tried to tackle rising inflation. And since then, they've made three rate cuts along the way, and with the two most recent ones being consecutive rate reductions. Right, so you can see here the main refinancing rate previously stood at 3.65% in September, and they reduced it by 25 basis points to bring it down to 3.4% in October. Right, so disinflation, as we saw in the statement, as well as during President Lagarde's press conference, right, disinflation is progressing well, and inflation in the Eurozone fell below the ECB's target of 2% for the first time in more than 3 years, right? And also, we've also noted, right, inflation is expected to rise in the short term. So that means over the next couple of months as we see out 2024, but it should decline toward the 2% target once more throughout 2025. Right, wage growth remains high, but pressures are easing. Right, although incomes have increased, we have not seen that translate into higher household consumption. Right. So what was the immediate reaction from the euro following the announcement of the monetary policy statement and during ECB President Lagarde's press conference? Let's take a look, right? So we can see here the statement was released at 12:15 p.m. GMT time on Thursday, 17th of October, followed by President Lagarde's press conference half an hour later at 12:45 p.m. GMT. Now, with the clocks moving forward as well, right? So when we look at the charts now, we're actually going to be looking at 1:15 p.m. GMT time and 1:45 p.m. GMT time. Take note, daylight savings has taken place over the weekend. So that means what was a 12:15 p.m. GMT rate announcement is now going to be at 1:15 p.m., followed by the press conference at 1:45 p.m. Right, so looking here, right, I'm on the 15-minute chart for the euro. This is 17th of October. The first horizontal line that we see is when the statement was released. That's at 1500 hours or 1:15 p.m. And the second horizontal line that you see is at 13:45 hours or 1:45 p.m. GMT time. So you can see here the immediate reaction it was in the euro was to rise slightly higher. However, after that, it reversed course to drop sharply, and it continued to fall even further during President Lagarde's press conference. Right, it was trading at around approximately around 1.0865 prior to the release of the statement and the commencement of the press conference, and it proceeded to drop as low as 1.0810 by the end of the press conference. Right? So this was a almost a 40-point move within an hour or so. Right, looking at the 1 hour time frame, we can see right it rose. Yep, it rose as high as 1.0880 and dropping down as low as 1.0810, and before consolidating around 1.0820 uh, for most parts of Thursday and early Friday, 18th of October. We saw demand for the euro pick up and rise up towards 1.0870. Right. Now, what does it mean for the ECB moving forward, right? So to get an idea of what they are likely to do, right, let's take a look at some of the key macroeconomic data in the for the euro area, right? Starting off with GDP. So this is GDP, quarterly GDP data, and we can see that GDP output, right, on a quarterly basis has picked up quite steadily in 2024, right? After contracting in the fourth quarter of 2022, GDP activity or output sort of recovered, but it was fairly muted throughout 2023. But in 2024, we've seen economic output pick up quite meaningfully, right? And we can see the latest result for the third quarter showing economic activity expanding at 0.4% in the third quarter of this year. Now, this was also the strongest growth rate in over 2 years, right? You can see here the last time we saw growth above 0.5% was in 2022, right? Early 2021 and early 2022. Right, and looking at it on an annualized basis, right, what was a significant moderation in GDP output uh, throughout 2022 and 2023. We've seen that stabilize in the second half of 2023, and we've seen 2024 pick up in quite a meaningful way. We are well away, right, from GDP output readings as what we saw in 2021 and 2022, but it does look like the economic recovery in the euro area is starting to pick up in a slow and steady manner. Right, looking at trade balance has had been pretty strong for most parts of 2023 and 2024. However, the trade balance or trade surplus in August narrowed significantly down to 4.6 billion euros in August. You can see that here. It was as high as almost 20 billion euros in June and July, right? About 21 to 20 billion euros in June and July. But that surplus has narrowed significantly in August, dropping down sharply to 4.6 billion euros. Can be primarily attributed to the weaker demand outside of the euro area, right? As we saw in the statement and in the press conference quotes, uh, highlighting the lower demand for European manufactured goods from global markets. Right. So should the trade surplus continue to narrow even further, or worse, should it fall into deficit, we can definitely expect the euro to come under further overhead pressures, right? When we see strong trade surpluses, right, that typically would provide some lift for the euro. And conversely, should we see the trade surplus narrow sharply as what we've seen in August, and should that surplus turn into deficits, that could definitely heavily impact or put or place further downward pressure on the euro. Right, looking at the PMI reports, this is for the manufacturing and services sector. So on the left, I have the manufacturing PMI chart. I have the PMI chart for the manufacturing sector on the left, and the PMI chart for the services sector on the right. And we can see here, manufacturing activity has remained in contraction for almost 28 months. This is more than 2 years, almost coming to 2.5 years, where manufacturing activity has remained significantly depressed in the euro area. Right, this has been the longest downturn since records had begun in 1997. Right, and looking at services was relatively strong from the second quarter of 2024 onwards, right? Registering pretty decent readings of 52 and 53 from April till August. However, the rate of expansion has slowed down quite significantly in September and October, right? New orders decreased for the second consecutive month, and this was also the fastest pace of declines since January, right? So although services sector looks to be holding up pretty well, but we can see that the pace of growth has slowed down quite significantly. And if you're not too careful, we can even see the services sector fall into contraction as well. Right, looking forward, right, softer demand conditions continue to pressure overall business confidence. And when we look at the composite PMI chart, the composite PMI chart is simply the combination of the manufacturing and services data. And we can see that over the last couple of months, it has fallen into contraction. A reading below 50 highlights contraction. A reading above 50 highlights expansion. So we can see here, 50 is just about here. And we can see composite PMI activity expanding pretty decently from March till August of this year, but now it has fallen down into contraction for the last couple of months, right? And not only that, we are starting to also see company respond to lower workloads by reducing employment, right? And this was the largest reduction in almost 4 years, right? And of course, business confidence has also dropped to an 11-month low. Right, looking at inflation, right? Remember when the ECB statement was released, we did not have October's data just yet. We only had September's inflation data. And at that point in time, we saw a sharp easing of headline CPI from 2.2% down to 1.7% year over year in September. So this was a very sharp fall, which brought a lot of cheer to euro traders as well, right? However, after the statement, after the most recent monetary policy meeting, we can see that preliminary estimates for CPI has now shown headline CPI accelerate up to 2% in October, while the core reading has remained unchanged at 2.7%. Right, so although core CPI has remained flat, headline CPI has accelerated as what was forecasted in the monetary policy statement as well, right? Remember, the forecast is for inflation to pick up slightly in the near term. So that means over the next couple of months. So we can probably expect inflation to edge a little bit higher in October as well, and sorry, in November as well, before we start to see it sort of moderate or flatline, and then start to ease ease lower or moderate lower and below the target of 2% uh in in 2025. Right, looking at home prices, right, home prices on an annualized basis had fallen sharply since the third quarter of 2022, right, and even uh, uh, experiencing disinflation, right, in 2023. So throughout 2023, home prices were actually falling much more quicker than expected, right? Had actually reached a disinflationary period. However, we've seen that stabilize and home prices have started to pick up quite steadily as well in the second quarter of this year, right? So home prices increase at an annualized rate of 1.3% in the second quarter of this year, right? And also, of course, if home prices continue to edge higher, that can also have an that will also no doubt have an knock-on effect on CPI data as well, right? Because CPI data will also incorporate the shelter components as well, which is basically housing. Right. Now taking a look at consumer spending, right? Consumer spending in 2024 has been relatively strong as compared to the period that was from this December of last year and in the first quarter of this year, right? We saw 3 consecutive months of lower consumer spending from December 2023 till February of 2024. Since then, consumer spending has been relatively strong, with only one down month being seen out of the last 6 months, right? So from March to August, we only saw 1 month of decline, and that was in June. And when you look at it on an annualized basis, we can also see that uh, consumer spending has increased quite sharply for the month of August, rising 0.8% year over year. Right, so consumer spending looks to be pretty steady. Right, it's not rising as much uh as the same pace as incomes. However, we can still see it's still a pretty steady rate of consumer spending in the euro area. Right. So this is also, of course, naturally going to keep prices slightly elevated, especially with regards to domestic inflation. Remember, the statement also highlighted the fact that domestic inflation remains high, and of course, that's going to have a direct impact. Especially, of course, if consumer spending remains relatively steady, and especially if we see monthly expansions of 0.3% gains, is what we saw in August, right? That is definitely going to keep domestic inflation elevated. Right. And looking now, moving over to employment, right? When we look at the employment change, that's the chart on the left, and we have the unemployment rate, which is the chart on the right. So you can see here, employment change uh, has been quite steady for most parts of 2024 and 2023, right? Definitely not seeing the strong employment gains that we saw in 2021 and in 2022, right? Euro employment change grew 0.1% in the second quarter of this year. So right, it's not really disastrous, right? It's not really seeing any negative employment change. However, we can see that the rate of employment growth has started to slow down. And what is also interesting is that the unemployment rate has dropped sharply, right? Although we see the rate of employment change slowing down, we've also seen the unemployment rate drop down quite sharply as well, falling down to 6.3% in September. When we look at job vacancies, we can see that vacancies have dwindled quite significantly over the last 2 to 3 quarters, right? It was as high as vacancies grew 3.3% in the second quarter of 2022. But since then, we can see vacancy growth tapering off. And especially in the second quarter of this year, we see it increase just 2.6% at an annualized rate here. So we can see, right, job vacancies are starting to pull back as well. And should we see that vacancies grow even lower, that of course would then have an impact on the level of employment change as well, right? We can expect lower rates of employment change, and that could also potentially mean we may see the unemployment rate start to tick higher as well. Right. So that's the macroeconomic data as of today, right, 5th of November. So right, all of which is pointing to another rate cut by the ECB, right? So you can pretty much pencil in another rate cut that's going to take place, I believe, 12th of December, right? Next meeting is going to take place on 12th of December. So we can, with the way the macroeconomic data is evolving, we can definitely expect the ECB to move ahead with a third successive rate cut. Now it's just a question of how large or how small will it be? Will they move ahead with another 25 basis point cut, or will they make another jumbo cut like what we saw in September, right? So it all depends on the evolution of inflationary or disinflationary process, and also on the level of economic output, GDP output, and PMI activity. If we see GDP output and PMI activity deteriorate even further, right, that could force the ECB's hand to move with a larger rate cut in December. Right. Now let's move on over to the charts and trading view and take a look at the euro, right, and see where the key significant where it is currently trading and where the key support and resistance levels lie. And also we'll take a look at the DAX as well, right? We can also see how the DAX has performed uh, uh, over the last few months, right? As we saw economic activity sort of stagnate and moderate lower. Right. So here we are on the chart for the euro, and I'm on a daily time frame here. So we can see it's currently trading around 1.0893, right? And after dropping down as low as 1.0782, right, we've seen the euro stabilize and stage a pretty strong rebound here. So this is a very strong downtrend, right, where we saw the euro, right, lose what is this here? Lose just over 4%, right, from peak to trough, or losing about 453 pips in a matter of about in a period of 4 weeks. Over the last 4 weeks, from end of September till end of October, we saw the euro lose 4%, shedding 450 pips over this process here, right? And as of now, it's sort of recovered, right? You can see the euro recover, rising from trough to peak about nearly 1.4% and gaining about 150 pips in the process here. Right. So very clearly, with the euro stabilizing at around 1.0780 in the third week of October, this is very clearly where the first support sits, and is in fact like a multi-swing low support here, right? We can see the euro stabilizing on 1st of August as well. We see a very nice swing low support taking place here at the beginning of August, and another swing low taking place here at the end of October. So this is a multi-swing low support for the euro, and that's at 1.0782, and we can identify this as the first support. Looking a little further below, there's another swing low taking place here in the third week of June, right? We can see the market structure showing us a pretty good swing low taking place here, and we can identify the second support at this level, which is at 1.0680. Now, what about resistance, right? What about resistance, right? When I look across this level here, and that's at 1.0946, I see a pretty decent, almost like an overlap level, right? Overlap resistance level. Now, why do I say that, right? Previously, we can see the euro making a swing high resistance here on 12th of March, making a second swing high resistance on the 17th of July. You can argue here as well on 6th of August, it made another swing high resistance. And when it finally broke higher on 13th of August, it made a small pullback on the 15th of August. After making this pullback and bouncing higher, it then creates an overlap level. So this was an overlap support until 9th of October. We can see a nice little support taking place here as well. Nice little bounce here taking place on 4th of October before the euro finally broke underneath this level. So what was previously an overlap support at this area can now function as a potential overlap resistance. So we've identified the first resistance for the euro at 1.0949, right? And that's an overlap resistance. Now, what about the second resistance, right? I see a nice pullback here, right? So actually this level previously functioned as a very nice swing low support in mid-September. And then when price breaks below this level here on 4th of October, what was a swing low support can now potentially function as a pullback resistance. So this is how we've identified the second resistance for the euro, and that's at 1.1011. Now, on this nice downtrend here, we can also run a Fibonacci retracement, right? Starting from this swing high on the 25th of September, going down to the swing low here on the 23rd of October, right? We can see that 38.2% retracement sits pretty close to the first resistance. Let's look at all the fibs. And we can see that, okay, 50 and 61% are in no man's land pretty much, so that's fine. Let's not force the Fibonacci retracement. Uh, should it not don't let's not force a Fibonacci retracement into the analysis if it doesn't align with the resistance levels that we had identified or with the support levels. So in this case here, we can see that 38.2% retracement sits pretty close to the first resistance, while the second resistance here, which is the pullback resistance, sits in between uh the 50 and 61. So I'm just going to keep 38.2% for now. Right. And let's see. Perhaps can we run a Fibonacci retracement from this swing low here? Let me take a look. Starting from 14th of June, is this the lowest point? Let's see which is the lowest point. Okay, the lowest point is here, 26th of June. Going up to the highest point here, which is on 25th. I guess this is still somewhat acceptable. Perhaps, yeah, it's not the best way to draw the Fibonacci retracement. We can see the trend line has not captured the market structure pretty well, right? Yeah, I think you can see a big gaps here to the upside, big gaps down here, another big gap here to the upside, and another gap here. So I think, right, I'm not going to force a Fibonacci retracement here because I see the trend line not capturing the market structure very well. Now, where I would like to draw a Fibonacci retracement would be something like this, right here, from this down trend here. There's a swing low here to the swing high on 26 September. We can see the trend line here, capturing the market structure very well, or perhaps from this instance here when price was rising strongly from 1st of August, and then it started to pull back in the beginning of September. I would have drawn a Fibonacci retracement between these 2 points as well, because we can see that the trend line captures the market structure very well. But for now, right, it doesn't really seem to do that. So let's not force the Fibonacci analysis into the Fibonacci retracements into the analysis. What I'm trying to do now here is look for potential extension levels. I think most of the extension levels may have been broken. Right, we can see, yes, 127% here, 161% here. Okay, that's fine. Don't need that. That's not valid either. Okay, let's see now. Now, maybe can we use a projection? Not too sure. Let's see if you can use a projection here. Right, I think perhaps we can use the projection. Okay, so just let me run that one more time. So what I'm doing now, I'm running a Fibonacci projection, starting from point 1, which is on 11th of September, going up to point 2, 25th of September, and ending at point 3 on 23rd of October. Now, what projection levels tell us is where price could eventually head towards, right? So as price makes this bullish reversal at the end of October and start to rise quite strongly, we've used the Fibonacci projection which involves 3 points. So we're going to be looking at the 61.8% projection level, 78.6% projection level, and the 100% projection level here. Now, we can see that price is trading close to the 61.8% Fibonacci projection. It has sort of stalled around this level here last Friday and yesterday as well, right? So it's good idea to see where if the euro can make a clean break above the 61.8% projection, because if it does, then we can definitely expect it to rise up towards the first resistance, which is an overlap resistance that is accompanied by Fibonacci retracement at 38.2%, and it's also accompanied by Fibonacci projection at 78.6%. Right. So for now, we'll keep 61 and 78.6% in our analysis. We don't need to keep 100% for now. Right. So we can see here we have a Fibonacci confluence involving the 38.2% retracement and the 78.6% projection, highlighting a strong resistance barrier. And not only that, we also have an overlap resistance at 1.0949, which we've identified as the first resistance here. So very key levels to watch out for. So if we see a clean break for the euro above the 61.8% Fibonacci projection, we can expect it to rise up towards the first resistance here and potentially stall around this level here. So if you've been long on the euro, right, if you've been long on the euro since last Tuesday, right, a clean break above the 61.8% retracement, a clean break above the 61.8% projection level, right, is likely to see this currency pair head up towards the first resistance. So identifying your potential take profit target within this resistance barrier would be a suitable area to do so. Right, so these are the key levels here for the euro on the daily time frame. And now let's take a look at the DAX. Right, so in this case here, Germany 40 is the instrument that tracks the DAX futures. Right, and we can see here, despite a very dire manufacturing sector, and with PMI activity, composite PMI activity falling into contraction over the last 2 months in the euro area, we still see equity markets, at least the German equity market, being elevated, right? So despite relatively weak economic output, we can see that the share price or index performance, right, sometimes can be a little bit disconnected from the actual from the actual economic activity and output here. Now, of course, it's also dependent on company earnings as well, right? The DAX is made up of the 40 major German companies, right, which are big auto manufacturers, industrials, pharmaceuticals, and energy companies as well, right? So there's a lot of other factors that come into play with regards to the share prices of individual companies, and of course, the impact that they have on major indices such as the DAX or the Germany 40 here. Now, we can see that the DAX has made an intraday all-time high. This was formed on 17th of October at 19,679.30. So this is where the intraday all-time high for the DAX was formed. So quite clearly, this is where the first resistance sits. And with the DAX stabilizing at around 18,982, this is where I would identify the first support. Right? You can see here, this is a nice overlap level for the DAX. Right? We can see it making a nice swing high resistance here on 3rd of September, running into resistance here from 19th of September till the 25th. After that, it made a bullish breakout on the 26th of September, and then it made a nice swing low support here on the 4th of October. So this then creates an overlap support level, which the DAX seems to have stabilized last Thursday on 31st of October. Now looking slightly higher, right? Actually, I see a nice pullback resistance level at 19,239. So this is where I would identify my first resistance. And the intraday high, the all-time intraday high, would be labeled as the second resistance here. Now we also have a nice downtrend that begins from this high here. Right, so we can run a Fibonacci retracement starting from 29th of October, going down to this swing low on the 31st. Let's pull up all the fibs. We can see that the 50% retracement aligns very well with the pullback resistance, which is the first resistance here. So let's just keep 50%. Right, and we can also probably run a nice Fibonacci projection as well. Starting from here, 0.1, 23rd of October, going up to 0.2, 29th of October, and ending at 0.3, which is at 31st of October. So if you look at all the key projection levels, we can see that the 78.6% projection level, I believe sits, no, it's the 100% projection level, right? Let me adjust the labeling. Right, 61 is here, 78.6 is here, is a 100% projection level that aligns very well with the 50% Fibonacci retracement, highlighting a Fibonacci confluence, which is where the first resistance sits, right? So we're going to keep just 100% in our analysis. And this confluence level, right, as highlighted by the 100% projection and the 50% retracement, right? identifies a strong confluence zone, which indicates that this first resistance is pretty strong. So what this also means is, right, if you've gone long on the DAX as of this week, perhaps, right, or as of this morning, right, identifying your first take profit target at around the first resistance here at 19,300 is a suitable area to do so, right? So anywhere from 19,300 to about 19,400 would be a suitable area or zone to identify your take profit target for the DAX. Now, what about the second support? Right, we can see that there's pretty decent like support level here, pullback level here. Right, this is almost like an overlap level in 18,723. We can label this as the second support here. And you can see when the DAX pulled back sharply on Friday, 20th of September, it stabilized around this level. And then when markets reopened on Monday, the 23rd of September, it gapped higher, dropped a little bit lower to close the gap before rebounding off the level to rise quite strongly. So this is a pretty decent overlap level at 18,723, which we can use in the identification of the second support. Now, is there any, okay, we can also run a Fibonacci retracement from this swing low here on 8th of October, going up to the intraday high on the 17th. The purpose of this retracement here on this uptrend is to find extension levels. So key extension levels sit at 127% and 161%. So we can see that the 127% extension level aligns very well with the second support, right? That adds further significance to the strength of the support zone. And we can see 161% sitting at 18,436. So as of now, we don't need 161%. We'll just keep the 128% extension level. Now, let's see. Can we also, there is maybe, we could argue, a pretty decent ascending trend line as well, currently in place, right? Not the strongest one yet, because we just see a couple of touches here occurring recently. However, as price evolves, maybe this trend line can serve as a pretty good indicator of the bullish momentum or the continuation of the current uptrend. Right, what else can we do? Let's see. I think this is pretty much it. These are the key levels here for the DAX, right? So take note, it's reopened, is rebounded quite strongly today, right? And should we see the DAX rising higher, right? Identifying your take profit target at the Fibonacci confluence as identified by the 50% retracement, and the 100% projection is a suitable area to do so here, right? These are the key levels here for the DAX. These are the key levels here for the euro. Right, it's a similar story for the euro as well. And we see demand for the dollar looking pretty weak, or demand for the dollar has waned since the end of October, pushing up the euro. Right, so should we see the euro make a clean break above the 61.8% Fibonacci projection, we can expect it to make a run towards this Fibonacci confluence that's identified by the 78.6% projection and the 38.2% retracement. Right, so these are the key levels here for the DAX as well. All right, so that brings us towards the end of today's webinar, right? So once again, here are some of the key takeaways from the ECB's most recent meeting that took place on 17th of October. Right, we've also covered the some of the key quotes during a press conference as well, and it points to a bleak outlook with regards to economic activity and PMI, with regards to GDP output and PMI activity in the euro area. Right. So, and uh, with inflation easing quite significantly, right? But we expect it to rise in the near term. And also looking at weak economic output, we can expect the ECB to move ahead with a third consecutive rate cut on 12th of December. The question is, now just how large would that rate cut be? Would we see another 25 basis point rate cut? That's quite likely if things evolve as what we've seen over the last couple of months. However, any further deterioration in GDP output or PMI activity, or even perhaps further deterioration in the labor market, would definitely push the ECB to make a much larger rate cut on 12th of December. All right, that's all I've got for you guys for today, right? Thanks for tuning in to today's webinar brought to you by Vantage Markets. Do do look out for all upcoming webinars by Vantage for the rest of this week. And I wish you all the best in your trading journey. All right, take care, everyone. Have a great trading week and catch you all at the next webinar.